There's no other currency of trust except for gold. I think that's where gold becomes quite interesting because gold now comes in as a way to patch that trust question. Even if there's this competition that's being attempted to compete with the US dollar, it's going to take a lot of time to reestablish these trade.
Hello, welcome to the Wiggin Sessions. I'm Addison Wiggin. Today I have with me Peter Spina. He's the CEO of goldseek.com and silverseek.com. Today, Goldseek is among the top 3 most visited gold resources in the world. We jammed about the significant changes Peter has observed in the gold market since beginning some 30 years ago. We talked about the macroeconomic outlook of the debt ceiling, banking crisis, inflation, disinflation, all of those are being mitigated by the mainstream press, but their underlying issues still remain. We talk about that. And we also talk about the war in Ukraine and de-dollarization that it has caused. All of those things have an impact on the value of the US dollar and the price of gold and the gold market as an alternative. We also talked about how macro and geopolitical events influence the gold price. They don't do it in the way that we expect because major institutional players are involved. And Peter explains exactly how the gold price does not rise and fall in tandem with geopolitical events as we might expect. Then we talked a bit about the advent of cryptocurrencies. For a time, Peter had stepped out of his positions in gold and he was trading in cryptos. But then after the crypto winter, as we call it, he has been more avid, and I think he said he was something like 95% in gold and silver. He'll explain his thoughts behind that. And then we talk about specific strategies for individual investors, even first-time gold and silver buyers. Peter gives a recommendation for how much you should hold in your portfolio. And he also talks about things that you should look out for when you're buying precious metals. Are you ready? Let's jam. Welcome, Peter. We have known about each other for many years, but this is the first time we're actually meeting.
Yeah, it's a real pleasure to meet you, Addison. I've been reading your work for a very long time. I remember the Empire of Debt book. I've been the IOUSA movie, and well, from the early days with Bill Bonner, reading your material was really helpful to educate me. And I see you as a mentor helping to, as an early teenager getting into the gold markets, trying to understand everything that's going on with the debt systems and the monetary system. So it's been wonderful to learn from you, and it's a real pleasure to be here with you.
That's great. Well, thank you. It's very complimentary. Before we begin, why don't you just tell me a little bit about yourself? You began there, but you started as a teenager trying to understand gold markets and whatnot.
Sure. I was introduced to investing from a very young age, and a part of the investing background came from my parents, from my dad specifically, who was very interested in precious metals. And he was subscribing to Jim Blanchard's gold newsletter, which Brian Lundin continues to carry on. So that was a big introduction into the not just the gold sector, but into the mining stock side. So I was very interested as a teenager learning about it. My parents are immigrants to the United States. They escaped the communist system in Czechoslovakia, so they had an understanding already of various aspects of the monetary system, the free market system. And not only that, but also understanding the United States, if you really want to get ahead here, you have to do certain things, which includes taking financial self-responsibility, investing, and saving, and certain other things that they taught me. And gold was one of those items that they saw as an excellent way to save. And back in the mid-90s, with the gold price crashing down to $400, $300, and eventually below $300 an ounce, it was a really interesting period to start getting interested in gold because the mining companies were starting to have production issues. The central banks were starting to change their tune from sellers and maybe ending the selling and so on. So yeah, that's kind of where I started off. And at the same time, the internet had become coming around, and I got introduced to it at a very young age. So in 1994, 1995, I started 3 websites, and one of them was on gold and silver and investing into the precious metals and into mining stocks. So from there, the site developed from a hobby into a business covering the sector and creating a platform for various contributors to share their ideas, because back then it was very difficult to get from the mainstream media a positive view of gold. Everyone was very anti-gold back then. It was a barbaric metal. It was a joke. All these PhDs have figured out the monetary system. We're civilized and we're beyond gold now. So it was kind of an opportunity to do that, and to also to follow my interest in the precious metals, but also more on the Austrian economic side, what gold is, what represents in the monetary system, and so on. So I've been almost 30 years now following the sector from a really early age and investing not just in the precious metals, but mostly into the junior mining exploration sector.
Yeah, I can hear you on the backlash, because when we started the Daily Reckoning in 1999, 2000, tech stocks were flying and gold was in a 20-year low, and that's when we were talking about it. And most people just dismissed us as kooks on the internet.
Yeah. And that's usually the best indication, I love contrarian mindset. And even within this gold sector, to be a contrarian, because when everyone is talking about gold and how it's going to just continue to rise, it's a time to take pause and question what the herd mentality is. But yeah, from back then in the late 90s, the herd mentality was tech, following the latest bubble, the latest hot sector, and gold was definitely not that. So
yeah, so let's just walk through your experience since the tech wreck, following the gold market. There's a lot of interesting things that happened along the way, and one of them is it rose tenfold.
Most people, most investors, they don't realize gold has done that well from the bottom, from the last 25 years almost, when it bottomed out. The gold price. In I think that was 1999. Was it the Washington Accord, or the European central banks had decided to no longer dump gold in an aggressive manner. So they had limited themselves to, I believe it was 400 tons gold a year that they would, in a more organized fashion, sell into the market. So that was oversupplying the market. There was not much investor demand at the bottom of the gold market. Everyone was chasing other stuff. And at the same time, you had a lot of hedging going on. I remember Barrick Gold, they were just hedging their future production way out so they could get a little better price. And so that the market was just oversupplied. But at the same time, the mine supply was falling, and it was creating, a situation where you could see that the gold price wouldn't sustain at these low prices. The exploration had ceased. There wasn't a lot of mines were shutting down and are having issues at the gold price. So you could see that the fundamentals were there. And in the bigger, when I got introduced to this, the debt levels were starting to get to be a little bit problematic, but that was back when the interest rates were at 5-6%. So until recently, we go back to the year 2000 or so, we were paying as much on our debt, the interest on the debt back then, as we were until recently, even though the debt was a fraction of what it is today. So, things were just starting to get interesting for gold, but as things always seem to take longer to develop than they do. And with where we are now, boy, it's a night and day difference, even though things are more fundamentally bullish for gold, I think, now than they were back in the late 1990s. But even though the price has risen, or the dollar has lost value since then significantly.
Yeah, so the gold price has gone up 10x, as I said. Most of the rise happened between like 2000 and 2008. And then after the financial crisis, or the panic of 2008, we actually had a real boom market in all commodities, because people were getting out of financial assets or getting away from Wall Street. And we had a boom up through 2012 or so. But then the gold price didn't continue to rise, which I thought was a kind of an interesting thing. It should have risen dramatically along with the CRB or whatever, but it kind of stalled out, and it stayed. I think it bottomed out again, not nearly 1990, 2009 levels, but in 2015, had become the barbaric metal again. Even though the Fed's response was to drop interest rates to zero, in my view, a lot of that money should have gone into the gold market, but it didn't. And we were following it daily. And what people seemed to be doing is taking essentially free money and investing in crypto, and pot stocks went crazy for a while. Like, people were using cheap money to go into these alternative assets, but gold just hung around for a while until about 2018, and then it rose during the pandemic and whatever. And now we're hovering around 2000. So my question for you is, what was going on in the market between like 2012 when we had a spike, and then it was like around 2021 that it got back to 2000?
Yeah, I think you nailed it there. I was part of that crowd who started to get sick of this gold market just dragging on, and then this new sector, like with crypto, was interesting, and this potential to replace gold and so on. So I noticed a lot of, especially silver investors and gold investors, started to follow the crypto side. And other general mainstream investors, they were chasing whatever the hottest market bubble was, and it took away from the precious metal story. But gold and silver bugs understood that the story was still developing and becoming more and more favorable for it, and it just wasn't being reflected in the price. It was just one of those lulls where, there's a great opportunity in the precious metals market, but no one seems to really care or notice it, and so they just kind of moved on to other sectors. I spent a few years really heavy into the Bitcoin side and cryptos in 2015-16. When I moved to the Czech Republic here, I joined a crypto group, not group, but it's an organization where they work with entrepreneurs to start crypto projects. So I was very fortunate to be in these groups of very similar minded, thinking kind of people, but it was very idealistic. And then when it came actually down to, can Bitcoin really compete? What is Bitcoin? Is it going to replace gold and all these things? Well, I went through all the emotions and all the questions, and I realized that it isn't what I thought it was going to be, and that what had happened and what's happening now is that it became a bubble, one of the largest bubbles that we've ever seen, and that it was going to be hijacked by Wall Street. Instead of crypto and Bitcoin taking down Wall Street and taking away the power for them, you had a lot of the hot money from Wall Street chasing it, and we saw a lot of incredible things happen in there. So it's hard to be in boring precious metals when you can have a crypto coin go up 5-10 times in value. Why would you want to be in gold, which it can go up 50% in value? It's just like the appeal wasn't there for a lot of investors, but it's the wrong thing to even question, because when you buy gold versus say crypto, it's all about risk and reward, but risk is a big factor, and a lot of people don't consider the risk side. And they learned a nasty lesson recently about what risk means, and that this was indeed a large bubble, and as easy as money comes, it goes. People make money, lose it, and that and other bubbles. So, the tech sector, you said that the pot stocks, they had all these other things distracting from the precious metal sector. But at the same time, it was a great time to start getting positioned. The gold stocks really came down. In 2017, I just liquidated at the portion of the portfolio that was out of the precious metal sector. I went fully back into it. And in 2018, I had been fully repositioned where I remain today, because I do believe it is coming. It's in the process of reviving, and we're at the verge of what I believe to be another big historic breakout in the gold price.
Okay, let's talk about that a little bit, because one of the things I wanted to ask you was about your own macroeconomic outlook and how you tie it into thinking about gold, silver, precious metals. We just had the debt ceiling pass, which was just political theater, as we all know. We had a brief bout with the banking crisis in March of 2023. Inflation has now become disinflation, so people aren't even worrying about the fact that prices are still going up, but they're listening to the narrative, which is it's under control and it will come back down. And then you have the war in Ukraine and de-dollarization, as after the Biden administration weaponized the dollar and the Russians started trading more heavily with the Chinese in currencies outside of the dollar. There's a lot going on. And generally, when there's that much activity in the geopolitical and macroeconomic space, gold is usually a beneficiary, but it hasn't really been able to break through 2000. It's hovering around. And I've had other people on the show who would say, yeah, well, if we break through this point, then it's going to hit 3,000. It's totally possible. And I do believe that that's possible. But how do you factor in all of those big picture items when you're thinking about where you allocate your money, your assets?
Well, I was getting bullish on gold before COVID hit, before the war hit. Things were already trending in gold's favor in 2018, 19 into 2020. So it was getting favorable, but now the timeline has just accelerated and new factors have come into play. I know, like you had mentioned, the war just accelerates this deglobalization, which causes more inflationary pressures and adds to the problems out there. I think it's really the number one issue, which also is going to influence the economic picture, and it's not getting better. And it's interesting. I'm here in the Czech Republic. We're very close to the war. And when I was visiting, say, Vancouver in January, you're so far separated, in the U.S. and Canada, you don't really realize like this is a serious war, and it's not just in the Ukraine. It's a physical war, but this is a geopolitical problem that it's pushed. A lot of things were already building, whether other countries, some issues growing, and now with like this war, we've got Russia being. Regardless of whose side you're on, Russia is now being pushed into the arms of China. There's a colder, what they call it, the freezing war or whatever, where you have two worlds, where you have the BRICS nations and then the West just separating itself from one another. So we're getting a breakdown and trade from that and issues, and now we're, like you said, the war created another issue, which is the dollar question. What happens when you become an adversary of the empire? Well, they can just electronically cut you off, because Russia had $600 billion, I think, or so in dollar reserves. They froze half of that. But Russia had, I think, about $10 billion in cash. So outside of the cash, everything's electronic. So, with some keyboard strokes, you can restrict access these days to the dollar system, whether it's using the SWIFT system or access to your dollars abroad. Now, that triggers a lot of questions for other countries who are looking at the United States saying, well, what if we, China, if we do something against Taiwan, how is the United States going to react? Other countries are worried, so they're going to start, they are taking action to limit their exposure to dollars. But even as much as I believe eventually the dollar, as much as it is overvalued, as much as I believe that the de-dollarization process is going to continue, I don't know. I don't think it's something that happens just right now overnight. It's a process that's going to take many years. The dollar is so ingrained in the entire world's trading system. The alternatives aren't really there. And a big problem with that is that there's no other real currency of trust except for gold. I think that's where gold becomes quite interesting, because gold now comes in as a way to patch that trust question. So, but still, even then, even if there's this competition that's being attempted to compete with the U.S. dollar, it's going to take a lot of time to reestablish these trade. We saw. Who was it? India and Russia had a swap line established. Well, suddenly Russia is sending all this energy to India, and they're flush with rupee, and they don't know what to do with it. So, it's not a widely used currency outside of really India. So, what is the currency that these countries who have these imbalances want to hold? And they don't want a bunch of second, third, these other countries with their national currencies that aren't also trustworthy. So, as many problems as the US dollar has, there's other fiat currencies that are a lot worse. So And it goes back to even the kind of the way I describe the US dollar. It's the least toxic fiat currency in the basket of fiat currencies. The US dollar index is just a measurement of these relatively toxic fiat currencies. So ultimately, the gold is a way to protect yourself, to de-dollarize. If you want to get out of the dollar system and you want to get your excess cash out, you go into gold. And countries are looking at that more and more. We're seeing China officially starting to talk about their increase in gold reserves. Singapore has been aggressively buying gold recently, and other countries as well. So it is a partial solution, but it isn't I just don't really see the system that's going to replace the dollar at this point established. As much talk as there is about it happening.
Yeah, even Russia has been piling up in gold.
Mm-hmm. Absolutely, they've been preparing this for a very long time. This has been a steady accumulation that they've been preparing for, because they realize the risks that happen when you go into a situation like this and you're in a state of war. And one of the tools of the war is to is in the financial system, economic system, and Russia is learning how the game is played, and other countries as well. So how do they deal with it? Gold is the alternative, and gold is still recognized as a global currency. And it's interesting because suddenly you're seeing, even like Ghana, a country having local issues with their own currency values, and their dollar reserves, their foreign forex reserves of dollars are falling. So what Ghana has started doing is restricting some of the gold producers from selling all their gold for dollars. So they're forcing 20% of their gold production to be sold to the government, and the government gives them local currency for that 20%, and then the government takes the dollars and uses it as currency to buy energy or other goods in the international market. So I think this is starting to become more and more of a trend, and this trend has been accelerated, not because the dollar is crashing in value, but more because of the dollar is actually quite strong, and there's actually a bit of a shortage in parts of the world for the dollar, even though there are a lot of dollars floating within the system, but certain parts of the world don't have a lot of dollars. They have a lot of dollar debt, and that's also a problem. So there's a host of things in this, and it doesn't really, so you look at the dollar and say, okay, it is overvalued, but it doesn't mean the dollar has to crash right away. Actually, there could be another Santiago Capital. Brent talks a lot about this. The dollar could still have a super spike in value against other currencies during a real liquidity shortage. But that doesn't really mean that the dollar is valuable, it's just a demand issue.
If we look at gold as an alternative currency to the dollar, I don't think the United States government recognizes it as a currency at all. But if we do look at it in economic terms as competition with the dollar, and the dollar is strong, that could keep the price where it's at, like $2,000. But at the same time, it would hurt the finances of the U.S. government and many of the Wall Street banks if gold was recognized as a currency and gained in value rapidly against the dollar. So there's a lot of theories out there that the gold price is being manipulated through the futures market. Do you have an opinion on that?
I've watched the market trade for years, and I've always been surprised at how aggressively some of the price sell-offs are compared to the rises in price. There's been these people call it the paper attacks. There's a lot of games being played in the paper market. It's already been proven in court that there's been spoofing in other games played by the large banks. And it's a paper market. So if you're a dominant player in the market, you can push it around. I don't believe that the gold price is fully manipulated, that, you could cut the price, really suppress the price heavily, because that would be reflected. But within a certain range, they play games. And I think one of the games that they do play to suppress the price is dissuade investors and speculators. So you see this traditional pattern where the price of gold starts to run up and the bullion banks start to unload a lot of paper. Some of it's the producers, some of it's hedging and so on, but it's this. The speculators are always getting hit hard by an aggressive amount of bank paper selling. So the bullion banks start shorting it, and now, like right now, we're seeing the gold price falling back, and they're starting to cover it. So If you step back and just ask a general question, is the gold price a threat to the U.S. dollar? I would say, yeah. They have their interests, and they've always had an interest to keep the value of gold lower to hide the real inflation rate and to reduce it as a competition to the U.S. dollar's global supremacy, the imperial dollar. So yeah, they have interest, and I would even say now I would question. With Russia's, they've been restricted in many ways, but they still have a lot of gold. So, they're trying to suppress the price of oil. You don't think that they're trying to suppress the price of gold and trying to unload some extra gold here to try to keep this gold price from taking off? I would definitely question that as a potential. We're in a state of war, and our adversary, the neocons, the empire's adversary, has something that they need to attack. So I think there's a lot of games in the paper market, but those games only work when the physical demand, when the inventory, there's not a lot of delivery of physical, and I think that'll be the driving force to overcome some of these games that are happening in the paper market. Is there's going to be real strong physical demand for precious metals. And what's interesting right now is that we have been seeing, not just in gold, but especially now in silver, a real strong dwindling in inventories of available warehouse vaulted metals. So that's going to become more and more of a problem. And once the Western investor really comes into the market and starts buying precious metals through physical means, I think that'll overpower this ability to kind of suppress the price and knock the momentum out of rallies and so on, to kind of delay the inevitable.
When you say Western investor, do you mean institutional investors or even individual?
Yeah, and even the retail. I mean, we've seen the last 2 years, the ETFs have seen net outflows of gold of investment. I think last year was over 100 tons of gold. And that's at the same time as central banks are buying nearly record amounts of gold, over 1,000 tons, 1,100 or whatever. There was a huge amount of gold buying. So the Western investors uninterested. They're not paying attention, and the second they do jump into the market, that they'll get in different means, the ETFs, the paper markets, and so on. So that'll be a huge new source of demand, and that'll be more difficult to control. We've also seen an interesting short covering in the GLD ETF and the SLV, some big short covering there. So something's going on. There's something's afoot, and especially with silver, I'd keep it close attention to that. And we can see what happens to the price when there's a real tight physical market in like palladium or in other commodities. We've seen even lithium and so on. Just you can really get a price explosion when the inventory gets really, really, really tight.
And you think that's happening in silver right now?
We're seeing it in silver. You see the COMEX inventories, large deliveries. You're seeing they're still, it's not dire yet, but the trend, there has been a very large decrease in available silver inventories. And at the same time, the shorting of SLV has stopped. One of the authors, I believe it was Ted Butler, in his estimation that the silver is being lent by JP Morgan to Bank of America, who's been heavily short, several 100 million ounces of silver. That's it's a theory. Some facts or some things that support this. It's hard to know. But in general, what we do know is that there's a very heavy short concentration in the silver market. It's the most highly concentrated short position in any commodity: silver, gold, platinum, palladium. But silver is 4 bullion banks pretty much have the vast majority of the concentration of shorts. So the small speculator doesn't really stand chance against that kind of house position.
Well, let's break that down for the individual investor, because most of the people that would be viewing this or reading stuff that I write, for example, are individual investors. Mm-hmm. They're suspicious of any kind of institutional. And so maybe we can sort of demystify some of the terms, like you used GLD and SLV. So GLD is an ETF that invests in gold, and SLV is a similar ETF that invests in silver. But those are paper assets that are traded by banks and traded by individuals. They don't represent the the bullion itself, or silver holdings. So like maybe explain how it is that for institutions could have a corner on the silver market, or actually they're trying to short it. So maybe the mechanics of that, because if somebody's watching this and they want to invest in gold or silver because it's an alternative to the dollar or the banking crisis or rising debt, those are all reasons to be interested in gold and silver. But if the market's being manipulated, there are certain things that people need to know about how the price gets established.
Predominantly, the price is being established right now in New York in the paper markets. So the paper markets are highly leveraged to the point where I don't have the latest numbers, but it has been traditionally around over 100 plus ounces of paper silver exists for every ounce of silver in the warehouse. So as long as the vast majority of those paper contracts never do get settled for physical delivery. So a lot of it is just paper just trading over and over and over, and it's not really actual physical changing hands. So that there's an ability to play games there when you don't have to actually deliver the real product. You can create unlimited amount of silver using futures contracts. But obviously you have to be a large enough institution to be able to have a book to support that kind of a short position or long position. But for the most part, what we've seen, I think, JP Morgan seems to be not really has adjusted its position in silver and gold, and in Goldman Sachs, they've been covering their shorts and so on recently. It just really seems that maybe it's a Bank of America that's heavily short silver at the moment, and maybe trying to unwind that at the moment. But yeah, they're using these products, these paper products, these derivative products. So, SLVs and ETF. And you do have, supposedly you're supposed to have all the physical silver behind it, but they can also hold futures contracts in the SLV. And if that's the case, then if the futures contract only has 1% of the future contracts in physical reserves, well, how much, of that? So, if you're buying silver, are you really buying a full amount? Does all the silver really exist out there? And the custodian for those ETFs typically is JP Morgan. So a lot of people don't trust them. They're a heavy player in the precious metals market, and if they're playing games with their products, there's a lot of suspicion what's happening out there. But I think these games are fine. Not fine. They work fine as long as the market isn't under heavy levels of physical demand. And in 2020, when the gold was being flown over from London to New York because there was such massive demand coming out of New York finally for physical metal, there are a lot of deliveries taking place. That's when we really saw the price take off. And I think that'll be kind of a similar thing here, where once the institutional investor is not, dribbling out of the market and starts really powering back into the market, these paper games where they're able to play these ranges and short it for a few dollars and cover, and just play these speculators who are on the other end of this trade. These speculators are highly emotional in the paper market. When the price drops, they're shorting it, and then when it starts running higher, they start piling into the long side, and then the bullion banks, and then they play the other side. So, they've been playing this game quite a bit, I've noticed, for a while, and it's it works within a certain time frame. But when the real physical market kicks on, and when the Western investor is asking for physical delivery, and the COMEX is getting a large amount of delivery, we do see some large deliveries happening right now, or are going to take place. So that's going to start putting more and more strain on the supply at the COMEX. So the question is, I think the ability, and in general, I would also say that there's a competition over the pricing power from the West and in general to the East, and the Shanghai markets and so on. China and Asia is really trying hard now to take the power of the market pricing power over to their markets, because they are the largest consumer of gold. They're China, Russia, India. They're huge consumers of gold in the Middle East, and yet we're pricing it through the paper contracts or the future contracts in the West. But There's a lot of things going on that front. It's going to take it's just part of the general problem where Asia is rising and the West is losing its influence, and one of that indications will be when the precious metals market pricing power starts to get more powerful overseas in Asia.
So if, let's say I'm a first time gold investor, and actually now I believe is a good time to be a first time gold investor. What recommendation do you make? Because all those games are going on. You can try to educate yourself about all the different ways that the paper is traded and how that impacts the actual bullion price. But if you're a first-time investor, you're mostly not going to understand how those games are played, and you're only interested in taking a position in gold because you don't trust what's happening, say, in the banking sector or whatever. Mm-hmm. What recommendation would you make for somebody who's just entering the market?
So even though I love the opportunities in the mining sector, there's a lot of cheap gold miners and junior stocks. Everyone should start off with physical. And physical means that you should hold it in your hand if possible, or vault it in a way where it's fully segregated and it's allocated gold. So you want to buy the physical metal. You can never time this thing right. At this point, looking at where everything is, I wouldn't be too worried buying gold right below $2,000 an ounce. Whether it gets back, down to the 1800s, it gets knocked down one more time, whatever. You can always cost average if you can cost average into this, or do it over a series of purchases. But I think the window is closing. I don't think there's going to be another year or two where gold is going to be under $2,000 an ounce, unless there's just a huge general market collapse where there's just a liquidity crisis and everyone's just selling assets for dollars so aggressively. But I don't want to get distracted on that scenario right now. But I think the gold investor 101 kind of advice is, start off by building a physical portfolio and accumulate. And it's a great way to save and have don't have the mindset that you're making this for a 6-12 month trade, or, gold is a longer term approach. There'll be times and periods like we've seen, and I've seen over the last almost 30 years watching this, where gold can be extremely unloved, out of favor, even though everything should fundamentally be driving the price up. And then suddenly the market starts to recognize it, something triggers it, whatever, a financial crisis, debt crisis, a bank issues. And then the gold price, it just starts taking off. And I noticed with a lot of investors, just even recently, when gold is at $1,600 an ounce, I got more people asking me, should I be selling, versus buying? And then when gold hits $2,000 an ounce, it's the opposite question. So, it's a reflection of the price. Psychology is always very similar in all markets. You want to buy when things are rising and sell when it's going down, when the opposite should be true. So if you do see a sell-off in gold, I think that's an opportunity. We're seeing that right now. This gold market is just pushing against this resistance area. I do think you break that in the next year, and then a lot of momentum buyers come in. And then traditionally, again, like when the gold market and silver market, especially when it takes off, that happens so quickly. And a lot of people are just, they're kind of watching it. It's you're either in the market at that point or just watching it, or you're trying to scramble to get into it. And then you end up overpaying because the price just gets a bit up too quickly. So I think this is a really opportune time. If you do not have any exposure, if you have no protection, you have no monetary, financial, any sort of protection using gold, I think this is the time to put something into it. And again, realize that things don't always happen in a period of months. You got to have a multi-year kind of horizon here. And I do think that this is the start of a big breakout in gold that's going to last many years, which will be a reflection of the declining dollar value and fiat currency issues. So.
Do you have a recommended percentage that people should hold in their own portfolios of gold or precious metals in general?
Well, I'm not a registered financial advisor, but when I think of it, it's like they say, put maybe 5-10%. Well, if you have 5% in gold, okay, it gives you a little bit of exposure. If your general, 5% of your portfolio collapses in value by half, and you have 5% in gold and it doubles, like, well, yeah, it did something for me, but it's not enough. So in my mind, I don't think until you have at least, I would say more closer to about 15 to 20% at this moment in time, do you have a really good a position of protection? So I don't think under 10% doesn't really make a lot of sense to me. I think you got to be 15, 20 or above. For me, 95 to 100% in the market. I'm fully committed. I do have some general commodities and rare earth and critical metals kind of in that mix, but I'm precious metals. I would say about 90 to 95% range, and the rest in other commodities. I've taken almost all my money out of banks. I have no interest in holding any debt instruments. There's just so much risk out there. The gold and silver, and especially silver, when you have these price drops, it gets smashed down from 25 to 20 and then goes right back. It's oscillating a lot. If you get it when these price smashes, it's a very low risk play. And you also get the benefit of silver being a commodity, green energy metal as well. So I do like silver also from that perspective, because that also has some good dynamics to it.
Okay, so I have one last question, because I know that you have to run, but I have this idea. We work with the Hard Asset Alliance, and they have a product called Metal Stream, which you can dollar cost average your way into a position in gold and silver are the two main things. You can do other things there too, but you can actually just add a little bit to your position each month. I think that it works better than a bank account, because you put it in, gold's pretty steady, and even if it's being manipulated, it's going to stay somewhere. Right now, it's going to stay somewhere around the 2000 price unless there's a breakout. So don't think of it as something that it's not a crypto thing that you're going to cash out in 6 months or something like that, but use it as a pretty safe bank account. And then you can actually pull money out if you do want to speculate with it.
I love that. I mean, in general, that's kind of been my approach. I bought actually the first ounce of gold I got was from my parents for Christmas when I was maybe 13 or 14 years old. And I grew up with parents who came from very strong traditional values, and saving was always one of the primary things they talked about. You have to save. So gold was always one of the ways to do that, and I think it's an excellent way to save. I said something, I think it was on my Twitter account. I have it pinned there, and it says, "You don't buy gold to make money. You buy gold to prevent losing money. It's a way to preserve your value." Even though I think there is an opportunity in a monetary crisis to increase the value of that purchasing power that gold will have relative to other currencies, fiat currencies, or other assets. But in general, you're using that as a low risk method to save gold, and to be able to do that over time steadily. I think it works great. Again, first ounce of gold near $300-400 an ounce, and I recently bought some when it was around $1,700 an ounce, and I continue to accumulate. And like you say, I think every month or whatever, these plans, you do it over time, and time flies, and soon enough you start to realize you start to build a nice secure portfolio of metals. And Hard Asset Alliance, I believe I met one of the individuals at a conference some years ago. So I remember actually, it's a great product. I love it. I traditionally try to do it every few months or something, even if it's a little bit, just do it. But if there's an automatic way just to auto invest, auto buy, that's great. Convert that fiat unit currencies into something real. And I think, again, over a period of time, gold, if it doesn't break out right away right now, you have a nice window to accumulate pretty nice relative prices now.
So if viewers or readers want to get in touch with you, what's the best way to do that?
I've been pretty active on Twitter. So at GoldSeek is my handle name there, but I do some writing and other interviews and so on goldseek.com and silverseek.com. So that's the primary locations or places.
All right. Peter, it's really good to meet you, and I would like to continue. We should talk more because we're in the same space.
I look forward to it. Thank you, Addison. It's really a pleasure to speak with you in person, and likewise, hope to meet you actually in person at a conference. We seem to be just
coordinate. All right, great. Thank you.
Thank you, Addison.
Thanks for joining me on the Wiggin Sessions today. It was a good conversation with Peter Spina. If you'd like to hear more from him, you can find it on goldseek.com or on his Twitter account at twitter.com/goldseek. That's twitter.com/goldseek. If you'd like to share our sessions, send your friends and family to jointhesessions.com. That's jointhesessions.com. At jointhesessions.com, we actually have a new special report that's called Anatomy of a Bust, and it talks about the banking crisis of 2023.